Welcome to the weekly update, where I'll go over the action in the market for the week of June 9th through the 13th, and we'll see how things look for the week of June 16th through the 20th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The markets will be closed on Thursday for Juneteenth. So we have a 4-day week coming up with a day off, like right in the middle there. But in the week that we just finished, it was a down week. We're still looking positive and we're improving on some levels. But then the news came out before the market opened on Friday of the attack or preemptive strike that Israel made on Iran, and that has the real potential of escalating. Iran is retaliating back, and then Israel is saying we've got even more in store. So plus, you have all the things happening in the U.S. over the weekend, the 250th birthday of the U.S. Army, I believe. And of course, it also happens to be Trump's birthday. And the connection is just too good for people that hate Trump to let pass. So they're thinking that he's throwing a parade for himself, where it just so happens that the anniversary happens to fall on his birthday. It's kind of interesting how that works. Okay. So going back over the week that we just finished, we were down 0.39%. So we did have a down day on Friday. We're not trending on the daily side. We're still looking positive and we're looking okay here. We'll go through the charts and go through these things. And there's a lot of this buy the dip. Well, those folks kind of got disappointed on Friday. We tried to go up, but then we ended up going down below that. So those folks are probably a little bit frustrated. We don't know what's going to develop over the weekend, whether it will have to do with the riots in the U.S., with Israel and Iran. We don't, and then there's always Russia, Ukraine in the background as well that could escalate at any time, or something else that we haven't even thought of. China might come out and say we have an even better AI program than DeepSeek. Who knows? But that's one of the reasons why I really stress hedging with your longer term investments so you don't get caught off guard like this. If we do have a declining period of time, it's not going to blow away all of the gains that you've seen. So, okay. And we're still below average with volume, and that's probably going to continue to drop off unless something really big happens, because we're starting to come into the summer months and we've already been below average with volume. It's probably going to go down even from there as we get into the dog days of summer. We are still looking more positive, and our weekly charts are improving, and I'll go through those. We are positive on the daily side too, not trending and not really showing much conviction after Friday. We were looking positive, and then we had the down day, which was not all that bad. As far as a down day, it was just, we were down over 1%, but it ended up making us negative on the week. And we are still seeing a weakening trend on the weekly chart. And the red line's coming down, the green line is going up. Okay, so for the week, the Dow was down 1.3%, and I have to turn on my pointer here. And the NASDAQ was down 0.6%, not a huge loss there. We were down 0.4% with the S&P. And because they had a good week a week ago, naturally the small caps had to have a bad week this week. I say that sarcastically, not because I'm involved with that index or even with small caps, but this has been for the last 2-3 years a very frustrating area for a lot of people who like to focus on the small caps. And it looks like, okay, they're going to do a little bit better. And they do it for a couple of days, and then they give those gains back. All right, so here's some points. Just have a couple of points to show this time. There is a lot of what I call it buy the dip, but they call it resilience. The market has been holding up actually quite well, but it couldn't avoid a lower finish on Friday, and we ended up being negative on the week because of the decline on Friday. Then the modest loss masked a week that was jam-packed with news. there was some optimism coming out of the trade talks between US and China. I mean, that seems like a decade ago now with things happening so fast. There was an encouraging CPI report that was taken as market friendly, and there are indications of trade deals with India, Mexico, and Canada. Nothing done yet, but they're in the works, and ending with concerns about the impact of the escalating conflict between Israel and Iran. And this could go on. It might be something more short lived, but it could also go on for a while as well. Okay, so I show this every week. We're still coming down here with the blue, dark blue line where inflation overall has been declining, and we're still kind of in that decline right now as measured by the CPI. But the reason I show this chart is just to be aware of this, that things can change going out into the future. There's so many variables out there. We don't know what's going to happen with the economy. We don't know what's going to happen geopolitically or even domestically within the U.S. And that might really wreak havoc on the U.S. economy and cause inflation to really go up. So we just want to be aware of that. Not predicting that's what will happen, but we just watch it. And that's why I do the videos every day, is to try to keep up to date with that. Okay, so we're still above 4.02% with the 10-year yield. We came in at 4.42%. We are underneath that 4.5% level with the 10-year yield, and that's more positive for stocks. But we're above the 4.02% level, and that's why we keep seeing earnings being revised down. Okay, this wasn't updated this week. It was from a week ago, showing the long-term unemployed, which did tick up in the latest reading. And then full-time folks, this wasn't updated in the last week either. All these charts at the beginning, I only update them after the employment report comes out. Okay, so, and we've seen this before. Volatility is the toll we pay to invest. Volatility means going down. So we look at the various declines here, and this goes back and studies this over a period of history back to 1928, where we see a 3% dip, okay? Then we have a mild correction, which is 5%, and then 10%. That's when we actually go into correction territory. And then we just kind of go between 10%, and then if we hit 20% down, which we got really close back in April, that's when we actually switch over to a bear market. But we were able to hit some solid support there and bounce up off of that. All right, then equity sentiment indicator here. Folks are still kind of negative overall. They were really negative at the beginning of April. It's improved as far as how people are feeling, but there's still a lot of skepticism, which could end up being positive for the market. Then composition of 81 trillion. That's whenever this chart was created. That's what all the stocks are worth in the world. 81 trillion, okay? It's more than the 37 trillion that the U.S. is in debt right now, but we would have to get stocks from other countries. But it's still the U.S. having the majority ownership stake in that. Then developed market valuations back to pre-Liberation Day levels. Well, that was before Friday. We're getting close here where we're starting, now we're overvalued, but when we look at this valuation here in the US, we are coming up. We're above the 20 level, but this is about where we were about the time when things started to not look quite as good. We're not quite there yet. We still have a little ways to go overall. Okay, biggest weekly jumps in Brent crude. This pretty much all happened in Friday's session. Now, I will say, I watch oil every day, and I talk about it in the daily video. And it had been in the high 50s, and it started to get back up to the low 60s, then the mid 60s. And so this actually was starting to go up before the attack took place. And then it really shot up in Friday's session. And this isn't one of the biggest spikes that we've seen with oil. We've seen a lot bigger ones before. Back, of course, here's the whole COVID, the price war between Russia and Saudi Arabia. That saw a really big spike up here. But this is something we'll keep an eye on because this affects all of us. Anytime we go fill up our cars or want to travel somewhere by plane, this makes everything go up, and that's a form of inflation. Then I did go over this in Friday's daily video. This just shows the bearish readings where they're really coming down. They were really getting very bearish. What I show is the difference between bullish and bearish readings, and we put that together into a latest reading. This is just showing the folks that are more pessimistic on the individual investor level about what's going to be happening. And just one post here from FactSet. They ask a question. Are more companies citing inflation on earnings calls during the first quarter? This, not really. It's about the same as what they've been saying. We're seeing a kind of leveling off here, and we're also seeing a leveling off on this other chart as well. So inflation is still a concern, but it's not as big of a concern as it was previously. So here is the intraday chart where we were just seeing things just chopping higher and buy the dip, buy the dip. We saw a lot of that. We hit the top on Wednesday, and then we started to come down from that. This is where we saw some later selling that came in, but then there was buy the dip again and trying to drive prices up. Then everything erupted overnight. We gapped lower. We came down to the 59.75 level, and this was still the amateur part of the market time here. You had to buy the dippers coming in, and they did a pretty good job. They drove us back up above S1. We got up to 6,025, and then the professionals came in and said, nah, we're going to be doing some selling today, and took us back down, and we closed just a little bit off of the lows in Friday's session. So we were looking okay on a weekly basis until Friday's session. So for the week, small caps were down the most. The NYSE was down the least. Going back to the beginning of the year, small caps were back down to the worst performing asset, followed by the mid caps. Both of these indexes are still below their 200-day moving average on the daily charts. And the NYSE, it's a broader market measure. It's more balanced. It's been holding up better when the market runs into some problems. But we are positive with the NASDAQ 100, which is growth, and we're positive year to date with the S&P, which is growth and value together, with the NASDAQ being up just a little bit, and now the Dow, it fell back underneath its 200-day moving average in Friday's session. All right, so looking at the different sectors, we had a down week, so I organized it according to what was down the most. Financials, and I'm keeping an eye on this, and I've been talking about it in the daily video. We look at the financial sector by itself, and it still has a pretty solid uptrend. But when you do a ratio of the financial sector to the S&P, it's really starting to underperform. In fact, it's still in an uptrend, but it's coming down to the 200-day moving average of that ratio. So we want to keep an eye on that and see if we get a little bounce from there. The industrial sector saw some profit taking. Communication was down. It's been one of the better areas lately. And then even though energy, it was up the most. And that's what happens when we have geopolitical events like this. Oil starts going up, the energy sector starts going up. It's more of a defensive area, and it ended up having a pretty good week. Then we go over to the scooter score. We still have tech in the lead. It was doing better. It's in the mid 70s now, as are utilities, which is more of a defensive area. But as I always say, you could also call this a growth area because of all the electrical needs that are going to be out there with AI and crypto mining and so forth. Industrials are still in the mid 70s, and communication still looking pretty good. Discretionary, it would be nice if this area was doing better. That's kind of a growth area, and it's the worst sector currently. And healthcare, which is more defensive. If we're more positive on the market, we don't mind that this isn't doing all that well. Okay, so just looking at the 5 trading days for the week, we had financials down the most. They're getting hit hard. We just want to keep an eye on that. Is there some kind of problem developing in the financial sector? We're just looking, we're not making any conclusions. We're just watching how the market is behaving right now. Industrials were down, and then we had energy. It was up the most, and a lot of that came in Friday's session, but it's actually been seeing some strength. Healthcare, another defensive area. Utilities, also usually defensive, as well as real estate. So growth didn't have a really good week. It's not falling apart, but we saw some more of the defensive areas actually doing better this week. Going back to the beginning of the year, though, industrials are still the strongest area, followed by utilities. Communication is still looking pretty good. Materials, which is more driven by the economy, were way over on the right. Discretionary is still really struggling. And then healthcare is also down year to date, and tech is not doing all that well these days. Okay, so we see a lot of red and green here. And this is a weekly look at the market carpet. Not where in the daily videos I show it for just that particular trading day. So it's a little bit longer term. And we see tech doing okay over here. The big companies where Apple was down, but Microsoft is up. Microsoft's been doing quite well ever since they came out with their earnings, and they just generated a golden cross. But then you see financials, a lot of red, awful lot of red in here. And that's what we're keeping an eye on. Amazon was down, but Tesla was able to be up over 10% on the week, where it fell over 14% in the previous week. And all of that happened in one day. Google was up where Meta was down. So we're getting kind of a mixed picture here. Then looking at the relative rotation graph, we don't really have anything going up and to the right other than industrials. That's green and looking a little bit better. So that's kind of one of the strongest areas over the last year. All of these other ones, you see they're going down and to the left. That's showing weakness. Now we are seeing tech coming on. Didn't have a great week this week, but over the last year, it's been coming on a little bit stronger. And discretionary was improving, but now it's starting to turn and go left where we want it to turn and go right here. And looking at it this way, industrials are about the strongest sector right now. They're about as boring as you can get for companies, but they seem to be holding up quite well. We have a lot of areas in the yellow where healthcare and energy, even with the bounce that energy got, remember that goes, this chart goes over the last year, how it's been performing. It's still negative, where we have tech and discretionary still looking more positive, but didn't have a good week this past week. Looking at the indexes, still seeing a real conglomeration right here around the midpoint, where we're seeing the NASDAQ 100 coming on. And that's what I was talking about a week ago when I did all the weekly videos. I said, let's keep an eye on the mega caps, the really big growth stocks, because it looks like they're trying to come back in and take a leadership role. And that still kind of continued this week, even though Friday kind of wiped out a lot of things. But we're just keeping an eye on that. And our growth to value ratios are holding up for right now. And then you have the S&P, the 500, you have the S&P 100 just kind of jumbled up here. Then the Dow Jones Composite, that's the NASDAQ, excuse me, the Dow, the utilities, and transports together. That's seeing some weakness. Mid caps, small caps, transports, they've been weak for quite a while now. And utilities are actually showing some weakness as well. Then looking at here in spreadsheet form, we still have the S&P 100 and the NASDAQ 100. They're still holding up a little bit better. The yellow areas would be the S&P 500 mid caps, which haven't done all that well, and utilities. And then the more negative areas would be the Dow Jones Composite, small caps, and transports. All right, then sentiment, we're still positive here. We're up in the 60 range. I don't say greed, I say positive. And then I say extreme positive if we get up to this level. Now, we were improving a little bit here as far as sentiment, and then Friday happened, and that took us down slightly. Then active asset managers, not really getting extreme right now. They're leaning a little bit more positive than negative, coming in at 82.66 with their latest reading. The VIX in Friday's session went back over 20. That's why you're seeing it above this line here. And that's a concern, especially if we stay above 20. If the VIX can come back down under 20 throughout the week, that'll be more positive for stocks. And still going down when we look at the tech sector to T-bills, cash, we want this black line to keep going down. That's more positive. That means the tech sector is outperforming. RIDEX bear bull ratio, folks are pretty bullish right now, but this only goes to Thursday. It doesn't include Friday, so it probably spiked up a little bit after Friday's action. And the individual investors coming in slightly positive when we look at the difference between bulls and bears here. The bulls are winning out 3.1 over the bears. And we are coming down with the Ulster Index, but we're still above the moving average, where we're underneath the moving average on the daily side. Not really seeing a concern here. The spread between risky and not as risky bonds still tends to be going down. That's more positive, but on this chart, it's when it's going up. We chopped down a little bit, but we've been kind of maintaining this level, this general area now for the last few weeks. So that's not really causing any concerns right at this point. And we are still coming down with the VIX and then the 3-month average of the VIX. And we're continuing to decline with the long-term moving average of the equity put call ratio. This is positive when this is going down. As far as the economy, no real change. We did drop down a little bit. Some of the reports that came out this past week were weaker than expected. And so it's not surprising that we're seeing a little bit of a dip down here, but we're still within this range that we've been in. And we're still coming down a little bit. We're below the black line with the National Financial Conditions Index. That's not causing any concerns. Then we have the Atlanta Fed GDP now coming in at just under 4%. Now, these were the guys that were like quite negative last quarter. They're actually more optimistic right now, where most of the forecasts are coming in just under 3% to the upside and just below zero to the downside. This is also showing the Atlanta GDP now Fed still coming in. This is looking better than what we've seen over the last few years. Actually, over the last year. Okay, then the New York folks that tend to be a little bit more optimistic, they're coming in with 2.33. That's positive GDP that they're coming up with. And this, I did change the chart because I didn't include the red line here a week ago. I went back in and put that in there. As long as we're below the red line, that's okay. Now, we did get up a little bit above it, and the perma bears love it when that happens. They think they're onto something, but we've been dropping back down below it since then. And now, if we continue to go up, that would cause more of a concern. Then the latest reading of the smooth U.S. recession probabilities, we are going up, but we're still below this black line. And this wasn't updated this week. We're actually coming down with the Brave Butters Kelly leading index, and that's more positive. It's usually when this is going up is when we go into a recession. Inflation, we did get CPI and PPI this last week, so there was some adjustments here. So we're actually coming down a little bit in the latest readings with inflation. As far as the Fed, they're going to be meeting in the upcoming week. They'll meet on June 18th, which is Wednesday. And there's a 99.6% chance they're going to leave rates right where they're at. So that's pretty much locked in right now. And that's what we've been seeing over the last few weeks and even on the last month or so. Now we're starting to still look out at the meeting at the end of July, but there's still a lot of variables. In some of the things that I read, they're already talking about September, but there's so much that can happen between now and then. That's why I only go 1 month further out than what the current Fed meeting is. But there's a 76.9% chance that the Fed's not going to lower rates at the July 30th meeting either. And still seeing that more of a conviction of what the market's coming up with. Still declining with the Fed balance sheet as they said it would. That's going according to plan. And we're kind of chopping a little bit here with the year over year balance sheet look. And not really seeing anything all that crazy. We're watching the financial sector and how it's performing on a ratio basis to the S&P, but we're not really seeing any warning signs according to this chart. So maybe something's just getting a little out of whack that will come back in and right itself. But we just want to keep an eye on that. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. The breadth on the weekly chart still looking positive, above the moving average based on price and volume. Coming down a little bit here with the 4-week moving average of the new highs, new lows. We saw more of a contraction of the new highs, a little bit of an expansion of the new lows. And we're starting to flatten out after we had been rising with the 10-week moving average. Declining, but still above zero with the advanced decline ratio charts. And here's where we're showing the weakening trend, where the red line continues to come down, the green line still coming up. We are trending, though, because we're above 20, but it's a weakening trend now that the ADX is starting to fall. But this is still negative, but improving. And we're still below zero with the Arun, where we're almost extreme positive with the Arun on the daily side. And we might be getting a mass index signal. This could be long term. Now, we have to look at this and think about what could happen here. When we were coming down Okay, the mass index really wasn't telling us much of anything. And then as we were starting to go back up, that's when this crossed above the red dash line and the blue line. Once this comes back down to the red dash line again, that's a reversal signal, according to this chart. We'll just have to see what the context is at that time. All right, then here's the daily chart where I pointed this out in the daily video. We're still looking okay from a chart pattern perspective. We're still seeing, for the most part, higher highs and higher lows as we've been going up, even though we came down on Friday. Now, one thing I also pointed out is we came right up to this dash line. That was the high that was set on Wednesday, and we were not able to get back above that for the rest of the week. And actually, we've been declining since that time. So there's some positive things that we're seeing right here and some negative things. Unfortunately, we're not trending right now. And we're still looking positive here with the 50-week simple moving average of the S&P. We're still in a downtrend longer term. We have the 13-week moving average below the 50-week moving average, but price continues to be above both of the lines. Trend channel still looking good here above the midpoint. And we did have a down week. So we came down with a red bar here for the week, but we're still above this pivot point. And even on the weekly side, we're still seeing a fairly healthy chart pattern here with higher highs for the most part and higher lows as we've been coming up out of the lows that were set in April. And still looking okay here with accumulation distribution. We're a little bit negative over on the daily side. Now we're positive. We're still above the moving average on the daily chart, and we're above it here on the weekly chart. I should have changed this. This is actually positive, even though it's pulling back. We haven't dropped below the moving average here on the boom indicator. So disregard this current negative. It should be current positive and green instead of red. Okay, now we are turning a little bit negative though with the chicken money flow. The histogram is declining and the red line's coming down. And we are declining with the chicken oscillator. So two of the three weekly smart money indicators are turning more negative. Vortex, actually, we're seeing a cross positive here. The green line is going above the red line, so that's positive. And we did decline below zero with the McClellan oscillator. So we're starting to come down, but we're still above zero with the summation index based on price. And we actually ticked up a little bit here based on volume. And that's what we've been seeing on the daily side. Volume has been showing more upward move than price has lately, and that could end up being positive. Bullish percent index just kind of chopping around right now. You can see the bar for the week was not all that big. And we have an up day, we go a little bit above the moving average on the daily side. We have a down day, we go a little bit below it. So we're not seeing an awful lot of conviction with the bullish percent index currently. And we decline, but still above zero with the swollen trading oscillator based on price. But see how it's still going up here based on volume? Our daily charts are picking that up as well. We did decline on a momentum basis based on price and volume. We're negative, but we were starting to improve on the daily side. And here you see the PMO. We're stuck above this red line on the daily chart. We're starting to turn back up here on the weekly chart. And we're below 50 and declining with the PMOs that are rising. We're declining with the buy signals, but we're still pretty much at a high reading. And it's going sideways with the PMOs that are above zero. We are still above the midpoint with the Bollinger Band percent B indicator. And here's where momentum is starting to turn back up, where we're looking a little bit more negative. We're just drifting right now on the daily side, where we're showing more of an improvement here on the weekly side. We're positive with the Copic curve, where we're still negative on the daily chart. We're positive with the force index. We're still looking pretty healthy here with the money flow. It's actually extreme positive. And we're above 50 with the RSI 14 week, where we're still looking good on the daily side there. This is the Stochk RSI showing us good longer term momentum, and that's positive. And then the Williams percent are also extreme positive currently, and coming down a little bit after getting extreme with the ultimate oscillator, but it's still above 50. However, the context is that now it's declining. And we had a slight down week, so we're below the midpoint with the 1 week rate of change. And we're kind of flattening out now with the 50-week rate of change. We're still positive with the weekly chart of the special K. We're still negative on the daily side. And I'll be showing that in a deep dive video. And we're still looking good here. We did have a down week, but we're well above these major support levels here where we bounced up off of these earlier in April. So we're still looking good with the Heiken Ashi weekly chart. We're positive with the Kagi chart, positive with the Renko chart, and positive with the three-line break, where we're getting a bit of a mixed picture now on the daily side. And we did go up enough in Wednesday's session to draw in a new X. So we're seeing a double top breakout that was generated earlier in June. So this point and figure chart is still looking fairly healthy. And we're improving, but still negative with the ease of movement. We've been hanging out right around zero on the daily side. Momentum longer term is still looking positive. We're still positive in the intermediate term. We declined, but we're still positive with the short term momentum here. And we're positive with the Elder's Impulse system. Still seeing green bars. We're still positive with the parabolic SAR. We're also still positive on the daily side. And this, I feel like a broken record here. The mid caps and small caps are still negative longer term. Everything else is still positive. Where we're seeing bonds, seeing a little bit of life in the short term. Commodities, which could be inflationary, they're actually positive in the short and intermediate term. The dollar just continues to get hammered. And okay, why is this chart on here again? Okay, in case you missed it. All right, so then looking at it's the previous, this is a newer chart and I'm not used to putting it in the video, so I'm trying to figure out where it should go sometimes. So looking at the S&P here, this is still looking pretty healthy overall, where the mid caps have been just pretty much chopping sideways. We're still not trending with the S&P, but at least it's been going up. And we did go up with the small caps and then we came back down. And so the Dow is still in a downtrend, but continues to be above the moving averages. On the daily side, we dropped below the 200-day moving average again. Also in a downtrend, but above the moving averages with the NASDAQ and NASDAQ 100. And in a downtrend and having a hard time getting above its 50-week moving average with the mid caps. And small caps has a ways to go to get to its 50-week moving average. So these are the weaker area. And we see that borne out here in the charts. The NYSE trying to turn back up with the shorter term moving average and actually holding up a bit better. It was only down 1/3% for the whole week. All stocks still looking pretty good here, just barely escaped the death cross, and now we're starting to turn back up with the moving average. And the FANG index, this is why I say maybe the big stocks are coming back in and taking leadership. We set another all-time high this week, not necessarily on a closing weekly basis. We ended up being down on the week, but this is also a pretty healthy looking pattern. And this is the index of the bigger stocks. The Wilshire, this is a daily chart, still above its 200-day moving average. ARC, trying to generate a golden cross here longer term. And this is another area, the banks. And see, we're just kind of chopping along sideways here with the weekly chart. We're still above 50 with the RSI. We're hanging on to kind of being positive here with the MACD on the weekly chart. And then we look at September from a seasonality basis. We're up 80% of the time going back over the last 5 years with a return of 1%. And then here is the Dow itself, which can't seem to stay for any length of time above its 200-day moving average. The transports have just kind of stalled out, and the utilities still continue to go sideways. Then commodities saw nice. Now, a lot of this could have been gold and oil in here. They had pretty good days on Friday. That's seen as a safe haven, and that's probably one of the reasons we saw the CRB index going up this week. Here's oil, and most of this gain, now it was coming up into the mid-60s already, but then it shot up into the mid-70s in Friday's session. We'll be keeping an eye on that one. Gold also had a good day on Friday. It's been just kind of chopping along sideways, but it's still in a longer term uptrend. And one of the best, probably it's the best performing asset in 2025. Silver also had a pretty good week. It continues to go up. The dollar continues to go down. Copper, even though it was down on the week, it's still in an uptrend here. That's good for the economy looking forward. And small caps just continue to underperform tech longer term. This ratio keeps going down. All right, we're still looking positive longer term with the total bond ETF. The stock to bond ratio, again, this is a monthly chart, so it won't actually be official until the end of June, but this is still looking pretty good. We're back above the moving average. Here is a daily look at the different yields. They were starting to come down, but then we saw a bit of a tick up in Friday's session. Also showing internationally how rates typically have been coming down lately. And then here's gold up over 30% year to date. And then energy went from last place and it's shot right into second place, where then we have commodities because oil is included in the commodities index. That also went up where stocks went down. We're still seeing bonds based on price being virtually unchanged. And the dollar is the worst performing asset so far in 2025. This ratio is still looking pretty good. The NASDAQ 100, which is growth to the S&P, growth to value, we're still looking good. We're starting to generate a longer term golden cross. S&P 100 still doing pretty good. Those are the bigger stocks that make up the S&P 500. This is more positive. Growth to value still looking pretty solid here. That's positive. And then gold to the S&P, where it's been chopping around quite a bit lately, but gold was just going up like crazy while stocks were going down, and it's been able to hold on to a lot of those gains on a ratio basis. And also, gold keeps going up when compared to the dollar. Low volatility stocks still decreasing here. That's more positive when this ratio goes down. Bonds still underneath the moving average when we do the bond to stock ratio. That means that stocks are starting to outperform. Discretionary, we wish this was doing better. It's holding up okay when we compare it to staples. And then energy to tech, it was really coming down, meaning energy was underperforming. And then we saw that boom bump up here. We'll see if this continues, that could be more negative for the market. And then here's small caps to tech that I just showed you. That's from a week ago. Okay, so a little bit of an improvement here with the NYSE breadth thrust. We're still working off of this WAG NYSE breadth thrust. It was generated back in April, and that's on the books for like, I think is it a year? Is it 6 months, 3 months? I forget how long it's actually on the books. And we're still above the long-term trend line with the weekly chart of the S&P going back to the 1987 crash. Here's a further blow up of that, still looking good on this chart. We're still right at zero with the Zohorchak method. We have been declining, but we haven't seen any changes lately. And we're still looking good here with the 50-period moving average of the new highs, new lows for the S&P. That's encouraging. That's showing more internal strength. And we're improving here with the NYSE 50-period moving average of the new highs, new lows. We're not quite above zero yet, but we are coming back up. And then we're still not quite back up to this trend line with the NASDAQ 100. I've been watching this. I see this chart every day. This might provide some kind of overhead resistance. Now, I draw this chart and I kind of eyeball it here, so it may not be exactly perfect, but we are coming up to the underside of that trend line. This ratio is still looking good when we look at growth, the NASDAQ 100 to the value, Dow. That's still looking pretty good there. And another growth to small cap ratio, still looking pretty strong that way. Still going sideways with the 3-month yield, not showing any problems there. And still trying to go up here with the cumulative NASDAQ, new highs minus new lows. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then seasonality, and I have a couple new charts that I moved from the daily video over here to the weekly video. June is not all that great going back to 1964, and usually the first half of June is better than the second half of June that I'll show you here in just a moment. But we're up 58% of the time and with a 0.2% return. And then we're in the June to November period, which tends to be okay. It was better than the time period we just came out of. And then we're done finishing up now with the first half of June. We'll be focusing over on the second half of June, which going back to 1950 tends to underperform. And this is a chart that hasn't been updated in a little while now, but we've been kind of tracking along what we typically see during post-election years. And we might see a bit of a decline here as we start to go into the second half of June and into July. That's a seasonal chart. But this chart actually has us doing better than that we should still be going up. Although we are, but we're not really trending right now. This chart looks more strong. It has more strength in it. And then no real surprise here. We tend to get a little lackluster as we start to go into the June months, both based on price. This is one of the ones that came over from the daily video, and I apologize for it being fuzzy. Going back to 1950, we're up 56% of the time with a return of 0.2%. This is also fuzzy, where if you just look at post-election years, we're down more than we're up. For the S&P, we're down about 0.5% for the month of June. This also shows how volume tends to really trail off in the summer months on the NYSE as well as the NASDAQ. So thank you. I hope you found this helpful. Wherever you are, I hope you are safe if anything crazy is happening near you. Have a great weekend, and I will talk to you in the next video.